were reserve requirements once the main monetary tool in finance history? Have you ever wondered how banks manage their money and what tools they use to keep everything running smoothly? One of the key tools in the history of finance is reserve requirements. These are regulations that requiring banks to hold a certain percentage of their deposits as reserves. This means they must keep a portion of their money either as cash in their vaults or as deposits with the central bank. Historically, reserve requirements played a major role in the monetary policy landscape, especially during the early to mid-20th century. The main goal of these requirements was to ensure that banks had enough liquid assets to meet withdrawal demands from customers. This concept can be traced back to the National Bank Act of 1863, which aimed to promote stability in the banking system. When the Federal Reserve System was established in 1913, reserve requirements became an official part of the monetary framework. Initially, they were used to provide liquidity to banks and support the Federal Reserve's credit policies. From the 1930s through the 1950s, changes in reserve requirement ratios were a key component of the Federal Reserve's strategy to influence the money supply and credit conditions. As time went on, the role of reserve requirements shifted. By the 1930s, the Federal Reserve recognized that these requirements were no longer just about individual bank liquidity. They had evolved into a tool for broader monetary control. However, reserve requirements were not always effective in preventing banking panics or ensuring liquidity during financial stress. This led to the development of other monetary tools. One such tool was the discount window, which allowed banks to borrow reserves against collateral to meet their liquidity needs. This created a more flexible currency supply that could respond to changing economic conditions. In the decades following the 1950s, the importance of reserve requirements as a monetary policy tool began to decline. Other instruments, like open market operations and interest rate targeting, became more prominent. This shift occurred because frequently changing reserve requirements proved to be challenging, and central banks developed more precise tools for managing the money supply. So, to answer the question, reserve requirements were indeed once a main monetary tool in financial history, especially from the late 19th century through the mid-20th century. They served to ensure bank liquidity and control the money supply. However, as central banks adapted to new challenges, their role diminished in favor of more effective monetary policy instruments.